Tomorrow could change everything for XRP and the entire crypto market. We started off the day with some important macro news. Initial jobless claims data just dropped. Actual came in at 218. The forecast was 213 and the previous reading was 199. What this tells us is that job losses are still coming in lower than expected. Fewer jobless claims means the labor market remains strong, and that's exactly how the market interpreted it. As soon as this data came out, we saw a bit of selling pressure across risk assets. That reaction was interesting because strong jobs data can delay rate cuts, and the market doesn't like uncertainty when it comes to liquidity. XRP reacted along with the rest of the market. We saw a sharp move to the downside, with XRP dropping all the way down to around 2.06 before bouncing. At the time of recording, XRP is sitting around 2.13. On the 4-hour chart, we did lose the 13 EMA and the 48 EMA briefly, which usually signals short-term weakness. However, when you zoom out and look at the daily chart, something important happened. We actually tapped the crossover zone and printed a buy signal. Price wicked down, touched that level and bounced. That's a key technical area, and it's one of the reasons why tomorrow could be so important. At this point, it's also important to understand that most people only look at price. They don't look at positioning, structure, or what's coming next. That's where preparation matters more than prediction. And this is exactly why I want to quickly mention the 100X Club. This is where we focus on exclusive weekly stock alerts for potential 100X stocks, crypto insider alerts, and simple strategies that help you think and move like the top 1%. It's about building a millionaire mindset, positioning yourself early, learning the 100 stock formula, and understanding how to scale capital the smart way over time. Clear systems designed to help you build real generational wealth and 100x your wealth over time. If that sounds like something you want access to, it's in the pinned comment. Now let's get back to what's happening because things are starting to line up in a very interesting way. One of the biggest headlines today is that the first XRP spot trading pair has officially gone live on Hyperliquid. This is important, and I don't want people to gloss over it. Flare has officially listed FXRP for spot trading on Hyperliquid, marking the first XRP spot trading pair ever available on the platform. This isn't just another listing, this is another real-world use case for XRP liquidity. Every time XRP gets integrated into new trading environments, especially spot markets, it increases accessibility, volume, and utility. Liquidity is oxygen for markets, and this is another step in expanding how XRP can be used, traded, and settled. These things may not move price instantly, but they matter over time, especially when liquidity cycles shift. Now let's talk about something that in my opinion is flying under the radar but could end up being a major catalyst. There are reports that Amazon Web Services and Ripple are working together on an XRPL upgrade. Specifically, AWS is reportedly exporting Amazon Bedrock AI capabilities to the XRP ledger. If this integration is fully implemented, XRPL system logs could be analyzed in 2 to 3 minutes instead of taking days. Let that sink in for a moment. One of the biggest friction points in large-scale blockchain systems isn't transaction speed. It's monitoring, diagnostics, and system analysis. When something goes wrong, or when performance needs to be evaluated, delays cost money and slow adoption. If XRPL can reduce system log analysis from days down to minutes, that's a massive efficiency upgrade. This could make the XRP ledger faster to maintain, easier to scale, and more attractive to enterprise and institutional users. It removes a bottleneck that most people don't even think about, but institutions absolutely care about. Faster diagnostics mean faster response times, better uptime, and more confidence in the system. This is how infrastructure gets built quietly, incrementally, and then all at once. Now, I want to shift gears for a moment and talk about risk because I always give you the good, the bad, and the ugly. We've talked about Zcash in the past. Recently, Zcash dropped nearly 20% in just 4 hours after news broke that members of their core development team resigned following internal conflicts. There was a lot of infighting behind the scenes and the market reacted immediately. Price collapsed, confidence shook, and then interestingly, it started to recover. Zcash dropped to around 380 and then bounced back to roughly 426. The reason I bring this up isn't to spread fear, it's to be realistic. Could something like this happen to any project? Yes. Even strong projects, team disputes, leadership changes, and internal disagreements are part of human organizations. No project is immune. That includes Ripple. Now, to be clear, there is no indication that anything like this is happening at Ripple right now. But as an investor, you always need to be aware that governance and team stability matter. This is why diversification, position sizing, and awareness are critical. You don't blindly marry any asset. You stay informed, you manage risk, you stay flexible. So when we look at XRP right now, we're seeing a mix of short-term volatility, strong technical levels, expanding infrastructure, and growing utility. At the same time, we're heading into a moment tomorrow that could act as a volatility trigger for not just XRP, but the entire crypto market. Markets don't move randomly. They move around catalysts, liquidity events, and expectations. When technicals, fundamentals, and timing start to converge, that's when things get interesting. XRP dipping below short-term EMAs but holding key daily levels tells us the market is undecided. The jobless claims data tells us macro conditions are still tight. The infrastructure news tells us long-term positioning continues to improve. And the expansion of spot trading tells us liquidity is quietly growing. Tomorrow may not just be another day. It could be a decision point. Whether that decision leads to continuation, consolidation, or another shakeout, one thing is clear. This market is setting the stage, and the people who win long-term are the ones who understand what's happening before everyone else does. There are a few things developing at the same time, and when multiple risk factors stack up, markets tend to get a little uneasy. One of the more concerning situations right now is what's happening in Iran. According to multiple reports, internet access is down, communications are restricted, and information coming out of the country is extremely limited. Whenever you see communication blackouts, that usually signals internal instability or preparation for escalation. On top of that, the United States has been signaling that it may get involved. Officials have hinted that the U.S. could potentially join the party, so to speak. Any direct involvement would immediately raise geopolitical tensions. And historically, markets do not like uncertainty tied to military conflict. When tensions rise in the Middle East, risk assets often sell off first, and crypto is no exception. There's also another angle to consider here, and we've talked about this in previous videos. Iran is known to be involved in crypto mining and crypto accumulation. If a government under pressure needs liquidity, there are different ways they can try to access it. One speculative possibility is that large holders could use derivatives or spot markets to hedge, short, or liquidate positions. I'm not saying this is happening, but it's something that cannot be ruled out. When markets feel fragile, even the idea that large players could be making moves is enough to cause volatility. Now, while all of that is important, the biggest event on the calendar is actually happening tomorrow, and it has nothing to do directly with crypto. The U.S. Supreme Court is expected to make a decision regarding Trump-era tariffs. This decision could have significant implications for markets' liquidity and investor sentiment. According to current projections, there is roughly a 76% probability that the Supreme Court rules these tariffs illegal under the existing legal framework. If the court does rule against the tariffs, there are two major consequences that markets will immediately start pricing in. The first is refunds. Tariffs that have already been collected may need to be returned to importers. That means cash that has already flowed into government accounts could flow back out. From a liquidity perspective, that removes money from the system and worsens short-term government finances. Markets tend to react negatively to sudden fiscal adjustments, especially when they are unexpected. The second issue is the deficit. These tariffs were projected to reduce the U.S. deficit by roughly $3 trillion over the next decade. If the ruling goes against the tariffs, that projected reduction disappears. That's not a small number. That's a structural shift in fiscal expectations. And markets pay attention to that. Now, it's important to clarify something here. A ruling against Trump's tariffs does not mean tariffs are permanently banned. What it does is block the current legal structure being used to impose them. The president would still have other legal tools to implement tariffs, but those tools are slower, more limited, and less efficient than the current setup. That's where the uncertainty comes in. Markets hate uncertainty more than bad news. Even if tariffs eventually come back through a different legal pathway, the transition period creates confusion. Businesses don't know how to plan, investors don't know how to price risk, and traders tend to reduce exposure until clarity returns. Trump himself has reportedly argued that tariffs are supporting economic strength and stock market performance. From that perspective, if the court rules against the tariffs, that narrative takes a hit. Markets may interpret the decision as a removal of a support mechanism, even if that support is controversial. Over the longer term, removing tariffs could reduce government revenue, ease inflationary pressures, and increase the likelihood of interest rate cuts. So it's a double-edged sword. In the short term, markets may react negatively due to uncertainty and fiscal concerns. In the longer term, lower inflation and easier monetary policy could actually benefit risk assets, including crypto. But markets don't move on long-term logic first. They move on short-term fear, positioning, and reaction. And this could help explain why we've seen XRP and the broader crypto market selling off slightly over the past few days. It's not panic selling, it's cautious repositioning ahead of a major decision. What's interesting is that the stock market doesn't appear to be overly concerned yet. The S&P 500 is still sitting very close to all-time highs. Equities are holding up well, which tells us that traditional markets are either confident in the outcome or simply not pricing in risk yet. Crypto, on the other hand, tends to react faster and more emotionally. When uncertainty is ahead, crypto often sells first and asks questions later. That doesn't mean something is wrong. It just means traders are de-risking ahead of a known event. Another important data point that we saw recently was related to XRP ETFs. On January 7th, we saw the first red outflow day since launch. US spot XRP ETFs posted their first net outflow, ending a 36-day streak of continuous inflows. That's significant, but it's also important not to overreact. After a strong 4 to 5 day run-up, it's completely normal to see some profit taking. Money doesn't just flow in one direction forever. Some investors take gains, rebalance portfolios, or reduce exposure ahead of macro events. That doesn't invalidate the trend. It just pauses it. When you look at the chart, the red candle lines up almost perfectly with that outflow data. It makes sense. We've had red candles before, but this time, the ETF data gives us a concrete explanation for the move. Some money came out after a strong move higher. It's also possible that inflows simply slowed while outflows increased slightly, which can exaggerate price moves in thinner liquidity conditions. Again, this is not unusual behavior, especially ahead of major macro decisions. What matters most is context. We're seeing geopolitical tension rising. We're seeing a major Supreme Court decision looming. We're seeing crypto markets slightly de-risking while equities remain calm. And we're seeing the first ETF outflow after an extended inflow streak. None of these things individually are catastrophic, but together they create an environment where volatility becomes more likely. That's why tomorrow matters. Depending on how the Supreme Court rules and how markets interpret that ruling, we could see a relief bounce, further consolidation, or another short-term dip. The reaction may not even be immediate. Sometimes markets wait a few hours or even a day to fully digest the implications. What's important is not to panic and not to get emotional. Volatility is part of the process. These are the moments where weak hands get shaken out and strong positioning gets built. XRP is still sitting in a technically important zone. Long-term infrastructure continues to improve. Institutional products still exist, and macro conditions are shifting in real time. Now remember, a lot of traders buying XRP ETFs are coming from the traditional stock market. Their expectations are very different from native crypto traders. In the stock market, if an asset goes up 15% or 20%, that's considered a massive win. Many of these investors are more than happy to take profits at those levels. So when XRP runs up quickly, especially over a short period of time, it makes complete sense that ETF holders might start locking in gains. That creates selling pressure even if the long-term outlook hasn't changed. This is something we always have to take into consideration. Profit taking doesn't mean the trend is broken. It just means participants are behaving rationally based on what they're used to. Because of that, there is absolutely a possibility that we see a pullback. So far, though, today's candle has already recovered a bit, which is encouraging. It tells us buyers are still stepping in on dips. That's why tomorrow is going to be very interesting. We're sitting at a moment where the market is deciding whether this move was just a reset or something more. And this brings us back to one of the most important concepts in all of trading and investing: uncertainty. Uncertainty creates sell-offs. Markets don't like not knowing. When traders and investors don't know what the outcome is going to be, especially around major policy decisions like tariffs, they tend to reduce exposure. We've seen this exact behavior before. Tariffs have already caused significant turmoil in the crypto market in the past. Think back to October 10th, when China tariffs created shockwaves across risk assets. Even earlier than that, in April, March, and February, tariff-related headlines led to volatility, fake-outs, and sharp corrections. This isn't new behavior. The market has memory. That's why tomorrow needs to be on your radar. It's not about predicting the outcome. It's about understanding the environment. When uncertainty is high, volatility increases. That doesn't automatically mean price collapses, but it does mean moves can be faster and sharper than normal. Now, another interesting development that hasn't gotten a lot of attention yet is what President Trump recently said regarding the Federal Reserve. Trump told the New York Times that he has already decided who the next Fed chair will be. He hasn't shared the name and he hasn't discussed it with anyone yet, but the decision has apparently already been made. That's a very important statement. The obvious question is, who is he going to choose? And just as important, how will that person approach monetary policy? Specifically, how aggressive will they be with interest rate cuts? If the next Fed chair is more dovish and more open to cutting rates aggressively, that could be extremely positive for high-risk markets. Crypto is one of the highest risk asset classes out there, and historically it performs best when liquidity is increasing and rates are falling. Now, to be clear, this isn't something that happens overnight. It could take 6 months or even a year before a new Fed chair officially takes over. But markets don't wait for events to happen. They move on expectations. If Trump announces the new Fed chair and that person clearly outlines their stance, especially if they signal lower rates, faster cuts, or easier financial conditions, markets could start pricing that in immediately. We could see a preemptive run based purely on forward-looking expectations. That's how markets work. They don't react to today. They react to what they think tomorrow will look like. This is not financial advice. So when you put all of this together, you start to see why this moment matters so much. You have ETF profit-taking pressure. You have geopolitical tension. You have tariff uncertainty. You have a looming Supreme Court decision. And now you have speculation around the future direction of the Federal Reserve. That's a lot of variables converging at once. At the same time, XRP is holding key technical zones. Infrastructure continues to improve. Institutional access through ETFs still exists. Liquidity is still present, and price has already shown the ability to bounce after short-term weakness. This is what a transition phase looks like. It's not euphoric, and it's not panic. It's cautious, it's reactive, and it's forward-looking. Tomorrow doesn't guarantee a massive move up or down. What it does guarantee is more information, and information reduces uncertainty. Once uncertainty starts to clear, markets tend to pick a direction. Whether that direction is continuation, consolidation, or a deeper pullback, the key is staying disciplined. Emotional trading during moments like this is how people get shaken out right before the next move. Zoom out. Watch how price reacts to news, not just the news itself. Watch volume, watch levels, and most importantly, watch sentiment, because sentiment shifts before price does. So we'll see how the market plays this. It's going to be very interesting, to say the least. If you found value in this breakdown, don't forget to smash the like button, subscribe to the channel, and check out the links in the description below. And if you want deeper positioning, weekly alerts, and strategies designed to help you think like the top 1%, check out the 100X Club. It's all in the pinned comment.